So hi everyone, I'm here with Tom Wood. So he is a board member of Bank of America and its UK broker dealer subsidiary, as well as he is involved with CIBC, Alberta Investment Management, and a lot of other companies. He is very experienced in the banking industry. So today we're just going to ask him a few questions. So to start off, the first question, in looking at the financial market landscape across both Canada and the US, what do you believe are the biggest changes you've seen, and what should be expected in the years and months ahead? And how do you believe financial institutions will adapt to this constant change?
Yeah, there has been a lot of change. I mean, I joined the business a long time ago. I spent my whole career in banking, investment banking at the beginning, and then CFO job and chief risk officer job. And now I'm on the other side of the table on boards. I would say the biggest change is one that you're quite familiar with, and that's the move to digitization. But not just at the consumer level. I mean, you and your friends, I'm sure, are quite familiar with all the new apps on phones, which are quite new to folks of my generation. But I would say it started in particular in earnest about 15 years ago, where the back office functions really reduced the cost of processing. And everyone's familiar with the extent to which checks have gone down. That saved banks in particular a lot of money. But the rising up of the fintechs is the biggest change, and the improvements in the mobile capabilities is one. One thing that doesn't get a lot of profile, but I would say is equally noteworthy in terms of change, is just the improvement in risk management in these big financial institutions, both in the hiring of new people, the improved technology, and just the overall liquidity and capital management, which I would say helped get us through this latest crisis. Together obviously with the government stimulus programs, compared with the 07-08 financial crisis, where the financial services industry obviously didn't do very well. Other things, the move to passive investment in the wealth management space. 20 years ago, most people saved for their retirement by buying stocks and bonds in their RSP. Now a much bigger proportion is held through index funds. Mm-hmm. So those are three areas that have changed quite a bit. And I think the big institutions that I'm most familiar with are staying ahead and are leading the change on those. I think in part, being pushed by the fintechs, who are keeping all the big companies, on their game, because it's become a much more competitive world.
Yeah, for sure. I think the pandemic has definitely also accelerated that digitization and changed the market a lot.
Yeah.
So moving on, as we talk about technology is playing a bigger and bigger role in our lives, and the biggest financial services firms in the US and Canada have responded by increasing the budgets of technology and innovation areas to drive new services, some even up by 30%. The benefits are there for greater competitive advantage, but also to decrease operating costs and create greater efficiencies. So the first question is, how is the risk of these new technologies and products being addressed? Ensure both adoption and competitive advantage while still protecting your shareholders.
Yeah, no, it's a good question. A big decision, because you've focused in on new products for any institution, is like, when do you roll it out? I mean, you can imagine, or you're perhaps familiar with, the desire of innovators to get the thing out the door, to get customers starting to use the product. And I think it's probably accurate to say the bigger the institution, the greater the concern about risk in introducing something. Now, I'm sure there are fintechs who would say, no, we're not going to introduce something that's not going to work. But the reputational risk to a big bank, for example, is huge. So I think there's a cautious approach there. I think there's a recognition that any product you introduce, you're going to constantly want to tweak it and improve it. But what you don't want is a headline saying, CIBC or Royal Banks introduced this product and it doesn't work. And the worst case, of course, is it causes losses or real inconvenience to customers. So I think there's even amongst the fintechs, I think there's a bit of a risk averseness there to at least counterbalance, the enthusiasm of the developers to get the thing out. So, but I think it's in balance.
Yeah, for sure. I definitely agree with that. So just kind of a continuation onto that, the time profile to implement and leverage these technology benefits usually grows with the size of the institution. Is that usually discussed at the board level? Like, for example, like a risk of new technology and innovation to the cost benefit of rolling out the proposed solutions faster?
Yeah, yeah, it is discussed. I mean, a typical bank, for example, would meet 7 times a year, 6, 7 times a year for 2 days a piece. And we would have a technology discussion at virtually every meeting. And technology has many facets to it. So far, you've dwelt on the innovation and the risk of products maybe not fulfilling their early expectations. But I mean, and that's what to use the sports analogy, that's the offense. You're trying to constantly stay ahead of your competitors. The defense is, being sure the stuff works, but there's a lot of other defensive technology work being done, obviously, in terms of cyber attacks, for example. That risk has escalated quite a bit. And the big FIs have been equal to the task, but through a lot of spending and a lot of hiring, to ensure your perimeters are protected, that gets a lot of discussion at the board. So it's both offense and defense, and that's escalated quite a bit in the last 5 years.
Yeah, for sure. Okay, so now moving on to kind of the implications of the pandemic. So digital channel use has accelerated significantly in most financial firms during the pandemic, as well as the adoption from both consumers and businesses on the use of startup apps and niche providers. Do you believe this move to digital is going to be permanent, or was this only a reaction to the pandemic and it will moderate or revert to more non-digital solutions?
No, it's absolutely permanent. I think the pandemic has escalated the use. I would say, like, even as recently as 3 or 4 years ago, there might have been a notion that it was more just for the younger people that are, or as the older folk are gonna, have their bank book and their checkbook. And so there's no question. I think in the payments business, the pandemic has escalated the usage and the sign-up rates for these products. But I think it's going to, I don't know. I mean, obviously the pace of growth will not replicate the pace of growth in the pandemic because we're now at very high usage levels. But I think it's definitely there, and it's going to continue to grow.
Yeah, I agree. The pandemic has definitely shifted the whole market, and it's going to be interesting to see where that growth goes. So now moving on to more a finance related question. So we're looking at current items in my corporate finance class. One of the potentially significant items I see happening is the imminent change to move away from the use of the London interbank offer rate, the LIBOR. It would appear to be a, quote, dog's breakfast of approaches from countries to incorporate how they set the LIBORs. What, if any, risks to the markets do you see? Is this more of a contractual issue with the rates are being referenced in each argument, or will this be a more like Y2K nothing burger issue when the changes are made? And is there going to be a period of risk with the new RFR frameworks come into place?
Yeah. No, I think it's under good control, Paige. The regulators in all markets have been very involved in this, and some have slightly different views. But the regulators all talk to each other so that it's coordinated. This is kind of a technical subject, but I would say for your viewers that it seems to be falling into place. There might have to be a few exceptions beyond the end of this year, which is the target implementation date, but. LIBOR itself, for those of your viewers who are technically inclined, they would know that it's a rate that has a credit component and a term component. Mm-hmm. The SOFR, secured offered financial rate, or secured overnight, I've forgotten what the acronym stands for, it's secured on treasuries and it's overnight. So it lacks those two components that LIBOR has. There's a third, and I'm trying to generalize and keep it simple here, rate that Bloomberg's been working on, and the regulators are looking at that as we speak. It has a term component and a credit component, and there's variations of that in Europe as well. So it looks like it's going to come in. It's largely contractual, but the industry and the regulators want to be sure that it's implemented properly, that the contracts are robust, and I'm quite comfortable that it will all play out well.
Yeah, I also agree. I think it'll be quite comfortable, but it will be interesting to see how that will play out.
Yeah.
So now more of a question about your career. So you've had a long career presenting to the board of a large Canadian bank, CIBC, and now you are on the other side of the table, serving on the board of one of the largest US banks, Bank of America, and its UK broker-dealer subsidiary, Merrill Lynch International. So I won't ask you to talk specifically about these firms, but I wonder if you could talk more generally about how bank boards provide proper oversight in a financial world that seems to be changing pretty dramatically.
Yeah. Well, most banks have a board of anywhere from 12 to 16 people. If you look at the proxy statement, you'll see that, there's quite a variety of backgrounds of people. As a very general comment, I would say most boards, banks have about half people who were former CEOs, and another quarter of people who had banking experience, and then another quarter of people that have a variety of backgrounds, so that you have a diverse group around the table. I think any governance sort of article or textbook would start with the point that the composition of the board and the way they work together is the most important thing. It has to be collegial, but it also there has to be enough industry expertise there to ask good questions, and you have to challenge management, because your job is a fiduciary for the shareholders. On the other hand, it has to be constructive, so that you're helping management do their job as best they can. Boards are then typically have 4 or 5 committees, and in any 2-day meeting over the course of your 6 or 7 meetings of the year, half the time would be spent in committees. Okay. It's quite notable, though, that technology is normally a full board issue. Okay, it's so important and it's so involved, and the whole board really needs to see it. Whereas the audit committee, the compensation committee, the risk management committee, and the governance committee generally have 6 or 7 people on the board, on the committee, and they get into more of the detail. So it's a balancing act between ensuring management's giving you enough information to make these judgments. You're not there to do their job for them, but you're there to get comfortable that we've got the right people in place. They're on the right track. And like 90+% of the time, as a board, you'd hear these presentations and you'd say, "Good for you, go for it. We're supportive." Okay. There are cases where management or the board would want to drill down further, but by and large, it's a confirmatory kind of discussion. There will be times when management would also present to the directors third parties, industry experts, or analysts from certain businesses. If there's an energy crisis going on, we'd have our oil and gas analysts present to the board. So those are ways that we can kind of connect the dots in the end and do our job as a fiduciary.
Yeah, for sure. So now moving on, I'm doing a stock analysis on JP Morgan Chase, which I'm about to release in the coming days. And one of the issues I'm trying to digest is the sheer size and breadth of some of these financial institutions and all of the other information available and the complexity of risks across the various business units. The MD&A for 2020 for JP Morgan is 141 pages alone. What process or approach do you use when you're looking across a financial institution and evaluate all the risks going on?
Yeah, well, it's interesting. JP's, all the banks' documents have gotten bigger. Part of it is, playing defense with potential litigation. But if you actually read the material in detail, as you probably have for JP, it's very good. It's for someone coming at it for the first time, and I know you're not, but for a casual reader, it can be a little bit overpowering and intimidating. But the disclosure has improved dramatically over the last even 10 years, let alone 20 or 25 years. So I would say, if you're looking at a company or any stock, but certainly big companies that have quarterly earnings reports, they do a webcast. And most companies, and JP would be an example, would have that on their website. So if you really wanted to get to know them, to me, that is the best way to not only get factual information, but to make a judgment on the capability of the individual speaking, as best one can by listening. Okay, that's one day. Then other things are equity research reports, and and financial press articles. And then if you have the time, compare that to other companies, both large and small. I think in the FI space today, we're going through a fascinating period where you've got the fintechs not only proliferating, but attracting huge stock market values. PayPal and Square are the two that come to mind. And you're seeing the fluctuations in price week to week quite significant. I mean, PayPal is I think down 15% in the last 2 months, but it's been up massive in the last 2 years. So there's a high standard that investors are placing on those fintechs continuing to attract new customers and volume, as compared with the banks and insurance companies and other companies where maintaining market share in their already established businesses is the main criterion people are using for assessing them.
Yeah, for sure. Like when you look at banks, it's more of a stable investment versus like the fintechs,
right,
or fluctuating a lot. So just a kind of a continuation to that question, what factors do you look at when you evaluate a new or updated risk assessment of a company or product?
I ask a lot of questions. I mean, and again, I say come at it from a bunch of different directions. Like in my case, and with other board members who have industry experience, it's a little easier, but things are changing. So it's a constant effort to stay current. Okay, and so it's reading equity research reports when you can get your hands on them, and then connecting the dots, comparing 5 or 6 companies in the same industry. On a product by product basis, board members really aren't equipped to make judgments on individual products, and that's really management's responsibility. But there are trends. I mean, if you're gaining market share or losing market share, that tells you something about the capabilities. So you talk to people, you read, you listen, and connect the dots, and ultimately, as a group at the board level, come to judgments in line with the CEO's input to you.
Yeah, exactly. I think that's the best method to go about it. Thank you so much for your time. That was the last question.